from YouTube. Great to have you here. You're very, very welcome. Just make sure that you can subscribe to the Admirals channel there on YouTube, or if you're here on Zoom, it's fantastic to have you here. We're going to be here to talk about trading sort of trends for beginners. So we are focused and aimed mostly at, people who are just starting out. I appreciate we always have a wide range of people here joining us for our sessions with Admirals. We have people who are complete beginners to people who are very experienced at trading. So it would be wonderful to hear what has been your own experience of trading trends. Maybe you're a complete beginner and you're just learning to understand. Maybe you've been trading trends for a great while and you're hoping you might just find, one or two extra little nuggets of insight that might help you. It would be great to hear what your own experience is. But please put it in the chat box, and that will help us sort of make the session even more even more useful for yourself. You'll also find that my wonderful assistant has put up a little poll there. Please be sure to sort of click on that, give us a little bit of feedback and an insight. Tina's here. She says hello. You're very welcome, Tina. Great to see you here. Great to see everybody here. I appreciate we have a kind of global audience, who join us. So from wherever you are joining us at whatever time you're joining us here on the live session, it is fabulous to have you here. So without further ado, just bear with me. I'll bring up the slides, and what we'll do is we'll have a look at our session for this evening. So just bear with us a second. Just bring up here all our elements here we've got going on for us, and here we go. There's always plenty going on here. So as I said, I'm hoping that you can hear me. I'm hoping that you can see the slides. And as I said, we're going to talk about trading trends for beginners. The truth is that the vast majority of traders begin with trading trends, all right? And most people are taught that, or most people are sort of, kind of positioned that is the way that they should operate. And there are a few reasons for that, which we'll get into as we go into the kind of meat of tonight's presentation. But, what I also appreciate is that sometimes, beginner traders, they don't really have a fully sort of encapsulate the kind of the ways that you can actually analyze trends, the way you can trade them, and have a couple of tactics that can help them. And that's what we're going to look at here this evening. So Gert says he's beginning about 4 months in trading. Well, Gert, you're very welcome here. Hopefully this will give you some fabulous insight and some just educational sort of tools and techniques that you can take away and utilize in your own trading tomorrow, which is always the way we kind of try and focus our sessions here at Admirals. So remember, here we are, Admirals, Forex and CFD broker with global presence and local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing you to engage with financial markets using the popular MT4 or MT5 or even Admirals Supreme Edition. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. Admirals are also on Telegram there, and as you can see, you can follow us on the @Admirals handle there on Telegram, where we give you a little bit more kind of timely information and news on that platform. And also there has been a Black Friday offer from Admirals, providing a 50% cashback. Please make sure that you register for that wonderful opportunity, and you can see the link there or find more details about it on the Admirals website. So what are we going to talk about if we're talking about trading trends for beginners? Well, not unsurprisingly, I'm going to focus on, how to identify a trend, give you a little bit of insight on how to identify kind of the phases of markets, which should hopefully help new traders. We'll talk about how to quickly identify the market environment. We'll talk a little bit about what are the kind of sort of typical kind of trading setups that traders can experience. We'll look at how to identify the best setups to sort of trade trends. And what I'll do is with that, I will give you, I'll share a couple of tactics with you that you can take away and utilize in your own trading. And not unsurprising, we'll talk about, how do you manage your trade? Okay, how do you manage, trading a trend when you're a new trader? So for those who don't know me, my name's Paul. I've traded for many years. I've traded for hedge funds, high net worth clients. Primarily, my focus is on FX indices, commodities. Primarily, I am a trend trader for sort of my swing and position trades. So there's experience there to sort of lean on for today's session. And I primarily look for mean reversion and reversal traders for intraday sessions, which is what our session on Friday will be about. So be sure to keep an eye out for the information on that at the end of this particular session. So trading trends for beginners. As the slide says, we often see that many new traders are looking for complicated trading strategies when they're beginning their trading journeys. And the reality is it's often the simpler methods that can help them as they learn to trade at the beginning of their careers. In this session, we'll look at a couple of simple trend trading methods that beginners can employ to help them engage with and trade markets successfully. So, as I said right at the beginning, is that, if you're new to trading, most people are sort of, they're kind of advised or guided to sort of trade trends. But, many people, if you're completely new to trading, you might not understand why, you might not understand, why that sort of, helps traders, how that benefits a trader over other types of trading, maybe, reversal trading or arbitrage trading or event-driven trading, etc. And, one of the reasons is that, when markets are moving in good trends, firstly, they don't happen as often as we would like. Markets tend to only trade about 20 to 30% of the time. So when you actually identify good trends, they tend to be very clear. They tend to be very simple. A good trend, as we will see in the charts, leaps off the page at you. And when you're new and when you're trying to sort of, trying to learn how to analyze markets, you're trying to learn and understand all the different indicators, all the different types of candlesticks, the different ways that you can engage with markets. It's sometimes easy, because it's quite visual to identify, very clear trends as a way and as a means for a new trader to sort of engage with markets and find a way to sort of, to basically ride new good trends. But what we tend to find is that, very new traders, they want to actually trade everything because, they're excited by markets. They're excited by the possibility and opportunity that sits there in front of them. And actually what we want to do is basically just give them a couple of ideas that they can take away, work with, and refine and hone to help them become the best trader they can be as quick as they possibly can be. And such that trading trends, is one of the ways we can do that. So let's start by having a chat about what I would define as the phases of the market. And I've got two parts to this. Because this is these are, let's say, the easier part. And, let's bring up the old drawing tool here, is that, in terms of phases of markets, I'd say we've got three very simple phases, namely the first one here on the left, the market is in a downtrend, How we can identify it's a downtrend is because just by looking at the price structure, it's clearly making lower lows and lower highs. And as I said, good trends, good trends will leap off the chart at you. Very often I find new traders, they're so keen, they're so excited that they're almost trying to, force their own projections onto the market itself. They're trying to basically make the market do what it wants to do. They're looking, they're seeing what's not really there, but what they want and hope is there. But with a bit of practice of, analyzing charts, what you'll find is that, good trends will leap off the chart. So on the left, we have a downtrend, and on the right, we have an uptrend. And hopefully you can see it's very clear because it's constantly making higher highs and higher lows. All right, so and it's effectively an uptrend. And then we have a sideways market in the middle, where, as hopefully you can see, the price is just effectively ranging back and forth between a couple of levels. Now, some people actually prefer to trade those sideways periods of consolidation. Some people prefer to trade those particular range-bound trades, and that is a very feasible way to operate in markets. But all of it comes to actually being able to demonstrate that which phase that market is in, and being able to identify that. And as I said, good trends will leap off the chart at you, Good trends will leap off the chart. Sideways markets, they are actually what's more regular, Choppy markets, sideways markets, range-bound markets, however you wish to label it, what you'll be able to see is, as the price action is there, it's showing, it's just literally bouncing in a range, normally between, you know, various range of high points and low points. So as a new trader, as I said, you know, when you're keen, you're excited, and you want to trade everything, what I suggest is, you know, just get into the practice of, you know, just opening your charts, okay, identifying, is there possibly a trend in here, okay? And as I said, good trends will leap off the chart. You don't need to, you know, if you find yourself having to force it, if you find yourself feeling, well, you know, it could be a trend, maybe it is, maybe it isn't. Let me tell you with years of experience, it isn't, all right? Good trends leap off the chart. You don't try to force it. Don't try to, you know, be impatient, okay? Just let that market do its thing, okay? Let the market identify itself. So, you know, there are effectively, as I said, you know, kind of three, what I would call simple phases there. And then there are a further two, which, you know, I would not expect beginning traders to really identify or recognize or understand, but with a bit of experience, you start to recognize. And I would say, you know, these are a bit more, you know, kind of advanced, which is about understanding when a market is transitioning in the first place on the left from downtrend to uptrend, or on the right hand where it's transitioning from the uptrend to the downtrend. And once again, you know, the market has been in a downtrend here. Hopefully you can see that it's making lower highs and lower lows, okay? It's quite clearly. And then effectively, you know, it really falls off a cliff. It's almost, you know, like a, you know, just it falls off a cliff, okay? Where you're just almost getting a, you know, price goes vertical, which, you know, or tell traders when price goes vertically, either down or up, that's normally a good sign that the end of that trend is very clear. And actually what we see here is that, you know, it's not terribly pretty, okay? And actually market looks like it consolidates, it then basically rounds up, then it drops back down again. But the significant piece here is that this low here, okay, is higher than these lows, okay? Then we start making this high is higher than this high, this low is higher than this low, okay? And what we have done is we have transitioned, okay? We have transitioned from, you know, from the downtrend to the uptrend. That is quite, you know, quite messy, quite scruffy. Welcome to trading, because that's what it's often like, okay? You know, when markets are transitioning out of one strong trend to another, it very often isn't pretty, okay? And, you know, and what I was saying earlier, good trends leap off the page at you. So if you're looking at that chart and you're unable to understand what's going on, you don't recognize it, you don't feel comfortable, that's okay, all right? That's okay. Just effectively, just basically step aside, okay? Let the market work its way through, and then you can effectively re-engage in the market when it starts to build itself into a trend that you particularly recognize. And here on the flip side, we've got, you know, a transition from an uptrend to a downtrend, and hopefully you can see that the prices are effectively, you know, prices moving up, it's making higher highs, okay, higher lows, and then it doesn't. And then what actually happens is the price has transitioned, okay, price is making now, starting to make, it's not from making high highs, now it's making lower highs, it's making lower lows, and we can see that the market has transitioned, okay, from an uptrend to a downtrend. Some people would look at that and say, well, Paul, you know, that, you know, could be viewed as a, you know, as a head and shoulders, which is a reversal pattern. Sometimes the transition can print a very nice, clear reversal pattern, but very often it doesn't. Okay, you know, very often it can be messy because at the end of a trend is messy, and that's okay. All right, that's okay. If you've been watching an uptrend and then watch the price action start to get very, very messy, very sort of, you know, it's just not following through. It's effectively just confusing you a little bit. That's okay. All right, that's okay. Just step back from it, step away, and just let the market do its thing and get ready, okay, to recommit to that market once it gives you a demonstration of what its new trend is going to be. What very often find is new traders, okay, you know, this is one of the reasons I've put these parts of this, what we quite often find is with new traders is that, you know, they have missed the trend, you know, they've basically, you know, let's say, you know, they've missed this up move, and then what they try to do is they try to call the tops in market. So they'll try to sell here, then they'll try to sell here, then they'll try to sell here, thinking that they can call the top, but actually the market can still carry on northbound, okay, and actually stop you out. And that's what very often new traders do, because it's their ego, their frustration. They have missed the trend, the dominant trend, and so they're trying to call the top in it or call the bottom in it. Let me give you a little bit of advice, all right? You know, trying to call tops in markets or bottoms in markets generally tends to be a bit of a fool's errand for most new traders, right? Tends to be a kind of, it tends to rarely end well for the trader, because you need that experience, okay? You need that little bit of, experience of having sort of seen markets transition, traded through markets transition, had a little bit of experience, okay, of recognizing, understanding when trends start to sort of run out of energy and come towards their end. So that's another reason why we're kind of sort of just, focusing on, for new beginners traders, to actually look at trading with trends rather than trying to trade reversals, okay? Trading with trends, okay, once you can identify them, that's a place for you to sort of engage with markets, rather than let your ego take over, trying to sort of, call the tops in markets, which, as I said, rarely ends well, okay? Rarely ends well for new traders. So there we go. There's a couple of phases of markets, and hopefully that gives you a little bit of insight into what phase a market should be. And when you look at a chart, when you pull up, let's say, a daily chart of anything, what you're looking to try and do is identify, okay, is that market in an uptrend? Is it in a downtrend? Is it clearly going sideways, or is it in transition? Okay, is it in transition from downtrend to uptrend, or from uptrend to downtrend? So, even if you can just take away from today, as a new trader, go away and just start practicing to identify those 5 phases. If you can identify those 5 phases in the market, that in itself will help you enormously, okay, with your own analysis skills, with building your own confidence, and help you being able to identify possible trading setups. What happens, when we go down towards trading trends, is that, when I break it down to its most sort of, simplest form, what I will tell people is that, if you go on the internet today, and you look, Google for trading and investing methods, you'll find that there are thousands of options out there, okay? There are thousands of options out there, some free and some very expensive, depending upon your wallet and your tastes. But really, you can break it down to one of 2 styles, all right? Most trading and investing methods, they are either a break, you are trading either a break of a line of support or resistance, or a bounce off a line of support or resistance. It is as simple as that. Now, you might find lots of different complex tactics within that, but I think for new traders, just to help you, okay, just simplify it, get an understanding of what's going on in markets, you'll find most trading methods are either a break of a line of support or resistance, or a bounce off a line of support or resistance. As simple as that. Regardless of what instrument you trade, regardless of what instrument you're trading, either instruments or timeframes. Look here. So here's a very simple example here. Okay, so this is on the dollar against the Japanese yen on a 15-minute chart. But what we can see is the price goes sideways, and you're able to identify your levels of resistance to the top, and then you can also identify levels of support to the bottom. And then what we see is that, of course, price breaks that level of support, okay? Price either breaks a level of support resistance, or it bounces off a level of support resistance. Keep it nice and simple when you start out, okay? Don't try and overcomplicate it, okay? Humans, and in particular men, and I've been guilty of it myself, we tend to overcomplicate things. We think it can't be this simple. It has to be more complex. There has to be more to it. And actually, there isn't. When it comes to trading, very often less is more, ladies and gentlemen. That's what I can tell you from my own experiences, and from coaching hundreds and thousands of traders over the years. On the flip side, you can actually look at having a bounce off a level of support resistance. This is a daily chart of the euro against the US dollar. And what we see is, price is in a very clear downtrend, isn't it? Remember what I said, good trends will leap off the chart. You don't try and force them, okay? Good trend will leap off the chart at you. And in this particular case, what we can see here is that price is bouncing very clearly off the 50-period moving average. Price is in a downtrend. Here we go. It's price, in a downtrend, pulls back and it bounces, pulls back and it bounces, pulls back, bounces, pulls back and it bounces. Okay, and sometimes in that particular case, you can see not only is it bouncing off the 50-period moving average, but you can also see at some of those points, that is where it intersects with horizontal levels of support and resistance. It's even stronger when you've got a confluence of events occurring, okay, where you might have a horizontal level of support resistance aligned with 50-period or another moving average, and also you're getting a particular price action candlesticks, well, then you've got, 3-4 things all coming together in one time and place. And that in itself can give you just a very simple trade setup as a way and a means to join a trend, okay, to trade with in alignment with the dominant trend. And I always put this example in because it's because I find it fascinating, and also it just gives you an idea of the kind of the scale and the scope that we can deal with. This is actually the Kiwi dollar against the Japanese yen from a few years ago, but the example is still relevant in that for effectively nearly 4 years. For nearly 4 years we had price, okay, bouncing off the 58 horizontal support level, and also bouncing off the 69 level horizontal resistance, and price just basically bounced off those levels, okay, for many years, okay. And so if you are, as I said, if you're a range bound trader, well then you're very pleased that there's some fantastic opportunity board. But even in the end, price actually broke out of that particular level, okay. Price came into that area, and after what was nearly 4 years, broke out of it. And what did it do? It went on to a completely new trend, okay. So as I said, price doesn't trend as often as we'd like, maybe only 20 to 30% of the time. But if you recognize that and you embrace that, and you just understand that that is part of trading, well, then that allows you to basically just be a little bit more patient, to be a little bit clearer in terms of what you're looking for, and helping you identify what phase the market actually is in. So when it comes to both of those trading methods, they both have their pros and cons, all right? Some people prefer to trade breakouts, some people prefer to trade bounces. Personally, I prefer bounces, okay, as part of a pullback when I'm doing my own trend trading, because it gives me an opportunity to get in a better price, and also I know if I'm wrong far sooner, which might sound strange to new traders. But what I want to know is, if my trade idea isn't working, I'd like to know as soon as possible, so that my capital isn't tied up for a long time, and also my emotional capital isn't tied up in the position for long. But what we'll do today in terms of how to trade trends for beginners, we're going to look at a simple breakout and a simple bounce strategy for you that you can take away and you can start to utilize in your trading tomorrow. So what we're going to use to help trade either particular kind of breakouts, what can use for breakouts and bounces, is just understanding the simple inside bar pattern, okay. We have gone into inside bars on quite a few considerable occasions in the past. You can find specific webinars just dealing with them in the Admirals YouTube channel, which you can find there. But an inside bar is formed when the high and low of the bar is fully within, okay, it's fully within the range of the preceding bar, right? Sometimes this, the bigger bar is something you'll hear it sometimes called the mother bar or the kangaroo bar. It doesn't really matter how you label it. It's about you understanding what is going on, right? I need you to think of it. The market in this area is like an organism, all right? It's like a human, it's breathing, okay? The way we operate. Markets are like humans. We surge, then we rest, then we surge again. And if you think about it, the inside bar is the rest before the next surge. And that's what we're looking to do. We use it as to identify, this might be an area where we can get ready to catch the next surge, to position ourselves to take a trend in the kind of the longer term trend. So just here's some good examples, okay, of inside bars. And the important thing is, okay, is that hopefully, as you can see, is that they are all within, okay, the range of win is all within the preceding bar, except this one, okay. Sometimes some people like to sort of work just on the bodies. Personally, I take on board the whole range of the bar, the high and the low. And for me, the high and the low of the inside bar has to be within the range of the preceding bar for it to be truly an inside bar. So just take that on board as you're looking at. And here we go. Here's how we can start to use inside bars in terms of trading trends. So this is a trend on the euro against the Japanese yen. It's the daily chart. I'm hoping that you can see the price has been in a very nice downtrend, okay, that has pullbacks, and here we have is that what we have in this price pulls back in a trend. We can see it hits the 20-period moving average. And then what we have here is you have a nice inside bar with a wick to the top, which is, it's not necessary, but it's nice when we see it. And actually what it does is, see how that inside bar forms. It's the end of the pullback, okay? It's the end of the flag pattern. And from that, price then moves down, okay? And that's what we're looking for. That's one of the ways that we can use inside bars to help us trade trends for beginners. Identifying that there is a trend, wait to see if there is a pullback, and then wait to see at the pullback if that pullback is ended by an inside bar. And if, as I said, the inside bar was also presenting, a continuation pattern, like in this particular case, a bear flag, that's even better. Remember what I said earlier, it's about having a confluence of events that you can work with to basically help you identify a better trade setup, okay? So that is one of the ways we like to look at, to use it in terms of trading trends. We can also use the inside bar, all right, as part of a breakout, okay? Remember what I said, some people like to trade bounces, some people like to trade breakouts, but it can actually also be used for breakouts as well. So in that particular case, what do we look for? Well, we wait for the breakout to occur, firstly. You can see in this particular case, price is going sideways. Then once the price is broken out and closed the other side of the range that we're looking for the breakout, what we're doing then is we're waiting for an inside bar to be printed. And then we're looking to trade in the direction of the breakout. So in this particular case, we can see, we had, in this particular case, we had a break, okay, of the southern, the level of support. Price breaks out of it, it closes beneath that level of support, and then the next candle is an inside bar. And so we'd be looking to trade in the direction of the breakout. So we'll be looking to have a short order here to actually capture the price moving down, which is what it did, all right? Remember, markets are like humans. We surge, then we rest, then we surge again, all right? And in this particular case, we surged, we rested, and we surged again. And think of that, okay? Just think of that, take that and bar, the market surge, they rest, they surge again. And that's one of the ways that we can use inside bars. Inside bars are the rest before the next surge. And so if you're able to identify them, well, then that gives you, a great opportunity. It's a great place to actually, to put your trade, on. And actually, this was kind of, a little other thing is, which we didn't talk about before, was that, we talked about how the inside bar was also the, the opportunity to trade the pullback. But the sharper eye amongst you would have realized once the price had broken out of that flag pattern, it then printed two, not one, but two inside bars before actually price made its move, okay? So, just always keep an eye out, okay? A, you're looking at pullback, but also B, once price has broken a particular level of support or resistance, well then, is there an inside bar that prints after it's closed? Because if it is, that might be an opportunity. If you haven't identified the first trade setup, well then that might be your opportunity. There's usually always a second chance, okay, a second or a third chance to get on board a good move. And in this particular case, this was a short-term one on the DAX, and actually what we can see is, price had actually gone sideways there, and then actually what happens is, how a period consolidation price breaks out, forms an inside bar, and then basically, well, that is the kind of the new trend that has come out of that period of consolidation. So, it's, that was a intraday short term, but it doesn't actually matter too much about the instrument at the time. It's about being able to sort of recognize how that price consolidated, price breaks out. Okay, it's the surge to break out, and then it rests. Okay, and if that rest prints as an inside bar, that is your opportunity to get on board that new trend right there at the start. And you can see that actually that move, that was quite explosive move there on the intraday DAX there for the next few hours. And here's examples on a bigger range, which this is gold. Okay, I'm hoping what you can see is price had a few months of going up before effectively you might say putting a triple top here in a range. It was transitioning out. Then what happened is we can see you broke the lower level of support. It closed outside of it, and then what actually happened? We started to see that there was not one but actually a couple of inside bars printing there before the new trend started, okay? And that's, that's what we're looking for. So remember to say, when I personally prefer to trade bounces, but you can see for yourself, inside bars can be used for both bounces and also breakouts. And it's when you see a breakout that is what might be giving you an indication that there's a new trend about to begin. So if you're able to identify those inside bars, that gives you, it's an opportunity. It's a setup signal that you can take to move with your trades. So, how do we look to trade that inside bar? Well, the kind of safe standard entry, sort of, what I'd be suggesting for new traders is that once you identified your inside bar, you're looking to enter on the break of the high or the low of that, somewhere between 2 to 10 pips, depending upon the time frame that you're trading, and also the time scale and the spread, with your stop loss on the other side of the candle, okay? Of the candle, might be even the other side of the mother candle, depending upon the sort of the distances revolved. When that happens, what I suggest is always, you look for a 2-to-1 reward to risk, okay? It's the standard way to trade inside bars, for new beginning traders, and that is the nice way, okay, to just, because you're very clear in understanding where you're in. You can also know where, where your idea is wrong and you're out, and also you can project, okay, and target 2 times your risk ahead and let that trade play out, okay? And that's, it's very simple, all right? Very simple, but remember what I said at the start. Sometimes new traders, they overcomplicate it when in fact less is more. So, with regards to that, we just have to recognize is that no trading method is 100% accurate, hence why it's always important we use stop losses and risk management. With inside bars, you have to also be aware of, there might possibly be a false breakout. That's why you trade them either as the end of a pullback in a trend or after a very clear breakout, okay? If you do those two things, then what that does is that helps minimize the opportunity for false breakout. So take note of that. I know no trading method is 100% accurate, okay? If anybody tells you theirs is, that they're talking nonsense, believe me, ladies and gentlemen, right? But this is why, we always have good best practice in using stop losses, making sure we have a good risk management. And as I said, you trade them either at the pullback, okay, end of a pullback in a trend, or after a very clear breakout where you can see there's been a very clear surge, rest, and then you're getting ready to surge again. So, that inside bar, it's a simple technical setup, can be used across all time frames and instruments. It can also be used for reversals and continuations, and it's very effective to trade after a breakout. But as I said, be careful of false breakouts. So that was the inside bar, which you can use for effectively to trade, okay, trade with trends for beginners, either at the end of a pullback or as a breakout. This is another very simple trade setup called a 3-bar reversal, which is set up to basically help you get on board trends, okay? It's a mechanical trade setup, covers over 3 bars, so it's quite visual, quite simple to recognize, okay? I like it for new traders because it's either there or it isn't, all right? There's not really that much ambiguity, okay? It's a very clear mechanical setup, which for new traders learning to trade trends is what is actually useful. It's time frame and instrument agnostic, meaning it sets up across the spectrum, okay, regardless of what you're trading. Today, in today's session, we'll focus on using it in FX markets, Forex markets, but as I say, it's set up across the board. And the location of where the 3-bar sets up creates the conditions for a trade, which we will go into now. So, perhaps you're a swing trader, okay, trading trends on weekly, daily, or 4-hourly charts. Or you can trade this on intraday, 16, 15, and 5-minute charts. The setup is the kind of simple one that you will always see on my charts using 20, 50, 200 period moving averages, all right? So, you'll also see I have fractals on there. What we're looking for those moving averages to be in alignment. So price should be above the 20, which is above the 50, which is above the 200 for a buy, or price should be below the 20, which is below the 50, which is below the 200 for a sell. So, we've got an idea that, we're using those moving averages to give an identification that, there is a trend building in place. That is our kind of, let's say, our first filter. And then we're looking for the specific mechanical setup. So, as I said, first point, define if there is a trend using price structures and moving average fans. If price is above the 20, which is above the 50, then we're looking for a pullback to enter long. Remember what I was saying, if you're trading trends, you're either trading a breakout or you're trading a bounce, okay? And looking for a pullback is like looking to trade a bounce. In an uptrend, price retraces towards support, and that support could be the moving averages. It might be, in this case, the 20 or 50. Maybe it's static, okay? Maybe it's a static horizontal level of support resistance. Maybe it's even something like a big round number that we see, okay? And that's what we're looking for with the, the areas we identify and focus on as an area for the actual setup. Then, it's a very simple setup. At that support level, if we have, in an uptrend, if we have two seller bars, red bars, followed by a buyer bar, a green bar, then we look to trade in the direction of the overall trend. So in this case, price has been above the 20, it's above the 50, it rallies up, it retraces back, we have 1, 2 red bars, followed by a green bar. That is our trigger, okay? It's a 3-bar reversal, 2 reds followed by a green. That is our trade to basically join, okay, this existing trend, right? That's what we're looking to do. Nice and simple, okay? Nice and simple. So, as I said, the most simplistic view is literally 2 red bars followed by a green buyer bar. But, what we do realize is if that green buyer bar is something like a pin bar or an engulfing candle, maybe an inside bar, perhaps even a spinning top, then that gives us more confidence. In this particular example, hopefully you can see that that is that's a bullish pin bar there, okay? Bullish pin bar, bullish rejection candle after the two red bars, and that is our entry, okay? That is our entry trigger. This is where we're looking to sort of join the trade and get long. What we look to do, okay, is we look to enter 1 pip plus the spread above the high of the buyer bar, all right? And our stop loss is 2 pips beneath the low of the 3 bars, okay? It's beneath the low of the 3 bars. Now, in this particular case, it is actually the 3rd bar, the buyer bar, which is the lowest. So our stop would go 2 pips beneath there. Our target is 1.5 times our trade risk, okay? So if, for example, let's say our trade risk is 30 points between our entry and our stop loss, well, our target is going to be 45 points, 1.5 times our risk. Nice and simple, okay, to begin with. There are ways as you grow in experience as a trader that might wish to change that, but actually to begin with, this is just a very simple way that we look to operate it. Or what you might wish to do is you could utilize a 3-bar trailing stop. So every time a new candle closes, you trail your stop, okay, underneath the low of the last 3 candles. Right, for a long trade, or above the high of the last 3 candles for a short. So you either have a target or you can use a trailing stop, because I appreciate some people like myself, I like to use a target. Other people like to trail the trades and see how far it can particularly run. Here's a little bit on trade management. If the trade is not triggered after 3 candles, then take the trade off, okay? Because what we're looking for like this is that price retraces and then bounces off. If price has just basically gone sideways, well, then the momentum hasn't yet returned, okay? And so there's no need for us to be in. And also, if you have your entry order in and then basically price trades beneath where your stop loss would be before it triggers your entry, then once again, take the trade off and look for it to reset. What's also important for new traders is that once that trade is triggered, let the trade play out, okay? Whether you're using a 1.5 target or you're trailing the stop, let the trade play out. Okay, don't try to interfere, okay? Just let the trade play out. What I suggest to traders is do 20 of those, then evaluate the trades. For the standard trade, for the standard setup, normally that hit rate, depending upon time scale or time scale and instrument, okay, you're normally looking to have a hit rate of around about 48 to 62%. Okay, it wavers a bit on the timer, but that's the kind of window you're looking for. And if you're using a 1.5 times, reward to risk, you should hopefully be able to recognize, that will give you positive expectancy for this particular method. For selling, it's exactly the kind of, it's reversed, okay? Now what you'll be looking for is you're looking for 2 buyer bars followed by a seller bar, red bar, at resistance. So we can see price is beneath the 20, it's beneath the 50. We then get a pullback, which is 2 green bars, followed by a red, okay, seller bar, okay, which you might also notice in this case is also an inside bar, and that gives you the opportunity to get into the new trend. Okay, so it's just flipped. Whereas for a long trade, you're looking for a pullback, which will have, you know, 2 red bars followed by a green bar on the downside, and for selling, what you're looking for is effectively 2 buyer bars followed by a red seller bar. It's just a flip. It's just a reverse. Okay. And so, you know, I have some examples here to end up. Okay, what we have here is, you know, this pound yen 15-minute chart. Okay, price is beneath the 20s, beneath the 50s, beneath the 200. Price pulls back, 2 green bars followed by a red bar, which is also a rejection candle before price pulls down. Okay, and actually, you know, this was my target here. It didn't. Here you go. This is, you know, sometimes the frustration. This is trading. Didn't actually, although it got to my target, I wasn't taken out on the spread. That actually happened overnight there. Okay, welcome to trading. That's sometimes what comes along. But, you know, it's the idea of the setup. Okay, that you let the trade play out. That's, you know, because that is also building good habits and behaviors in the trading. And this is, you know, pound against the Swiss franc on the daily chart. You can see that price has been in a strong uptrend. Price then comes back to what is the 20-period moving average, which is also around this kind of horizontal level of what was resistance becomes support. What do we have? 3 candles, okay, 2 red followed by a green, which is also an engulfing candle, and then price takes off and continues on, right? So, you know, uptrend, retrace. Once it hits support, you know, the 2 seller bars followed by a green bar. If that green bar, the third bar, is also, you know, an engulfing candle, a pin bar, that makes it even happier. And it's just a very simple, almost mechanical way for you to sort of trade trends. This was from a couple of years ago, and I just put it in because it's a fantastic example of what happens when a market is in a real strong super trend. And this was the Australian dollar against the US dollar. And over a period of the summer, what you can hopefully see is that, you know, price was beneath the moving averages. Okay, it was in a downtrend, and then every time it pulled back, it was 2 greens followed by a red. Pulls back again, 2 greens followed by a red. Pulls back, 2 greens followed by a red candle, dropping, 2 greens followed by a red, 2 greens followed by a red candle. Okay, and even at the end of it, 2 greens followed by a red candle. Okay. That it doesn't happen as often as that, ladies and gentlemen, all right, I can assure you that. But I wanted to show an example that, you know, when a market is in a trend like that, that is, you know, it is feasible, okay? It is very, very feasible. Because what you have to remember is that there's always those people who have been sat on the sidelines that are waiting for a pullback as a way and a means to join the trend. And so in this particular case, you know, people were waiting and rejoining that trend because they knew it was a very strong trend where we had Australian dollar weakness and US dollar strength. And this, you know, for even longer time frames, this is the euro against the Japanese yen on the weekly chart. You can see that the price, you know, price is making lower highs, lower lows. The 20 is beneath the 50. The price pulls back, 2 candles, third candle being an inside bar. So in this case, you'd be shorting here, okay, just beneath the low of candle 3, but your stop would be above candle 2, because the high of candle 2 is higher than 3. Remember, the stop would go above the highest of those 3 candles. And then, as you can see for yourself, you know, basically the price just does that as it zigzags, as it continues down, you know, in its strong downtrend. And this is another example on the Aussie dollar. Now we're on the hourly chart. As I said, I've tried to show different time frames to show that, you know, the setup is time frame and instrument agnostic. Hopefully you can see price is above the moving averages. Price is moving up. It pulls back, 2 reds followed by a green, pulls back, 2 reds followed by a green candle, goes up, 2 red candles followed by a green candle, 2 red candles followed by a green candle. That was on the hourly chart over 2 days, okay, as the price moved its way, or it's just ground its way up until what we can see is price hit this big long resistance zone and actually completely reversed. You know, there it transitioned from an uptrend, it transitioned into a downtrend there. And, you know, a couple of examples more. This is the daily chart on pound against the US dollar. Pound is, you know, here getting above its moving averages. Comes back. The price action isn't terribly pretty there, but it is 2 red candles followed by a green before it spurts up. Comes back, 2 red candles followed by a green, which is also, you know, an inside bar spinning top before it goes up until it's finished by that bearish key reversal engulfing candle there at this significant level. More examples here. Okay, euro yen on a 4-hour chart. I've tried to put in lots of examples for you because I appreciate that always helps to get an idea. Prices above the 20 and 50 period moving average. You can see it's been in an uptrend. Price retraces. One red candle, two red candle, followed by a third, which is a green candle. It's a bullish rejection candle. Off it goes. Comes back again. Off it goes. Okay, and don't be surprised. If you get in good trends, you get pullbacks like that, which you can take in terms of those 3-bar reversals. That's when you're in a good trend, there will be opportunities for you to join it. So just to finish off, to note that the 3-bar reversal tag is a simple mechanical pullback trading tactic. Firstly, define if there is a trend. Wait for a pullback to support, in an uptrend or resistance in a downtrend. For a long, for a buy, you need 2 seller bars followed by a buyer bar. For a short, you need 2 buyer bars followed by a seller bar. And it's where that setup appears that it is a key. We want to see it happening at a level of support or resistance. In conclusion, many new traders try to overcomplicate their life by trying to trade complicated trading strategies, and following a very simple plan would help them more. There are thousands of trading strategies out there, but they tend to boil down to one of either a bounce off a level of support resistance or a break of a support resistance. An inside bar can be used as a simple trading setup after a breakout, and the 3-bar reversal is a simple mechanical pullback trading tactic. You need to occur it as part of a pullback in a trend at a suitable level of support resistance, which provides us with the confluence of events, and it can be used across all instruments and all time frames. So before we go, just remember you can actually join me on Friday to talk about how to intraday trade FX reversals, talking about why is reversal trading popular for intermediate traders, what do you need to look out for, how can you do that successfully. And that's on Friday, 26th of November at 2 o'clock London time. Okay, be sure to check the webinar box for the link. If you want to contact us, you can do. You've got the Admiral Markets website, or you can email us at global@admiralmarkets.com. So there we go, ladies and gentlemen. Okay, I've just talked about trading trends for beginners, and I hope I've given you a few tactics there that you can take away and utilize in your own trading from tomorrow. They're just quite simple, but as I say very often, that can be the best way. Okay, less is particularly more. So I hope you found that particularly useful. I hope that gives you something to take away, to think about. Those of you joining us on YouTube, okay, fantastic to have you here. Great to have you here. If you are watching us on YouTube Live, or if you're watching this later on demand, well, then be sure to, click on the subscribe button, okay? Subscribe to our Admirals YouTube channel. Or if you've liked, if you found it useful, give us a thumbs up, or, maybe if you haven't, okay, give it thumbs down. That's fine. We want feedback. There'll be comments there. You can ask questions there, and the Admiral staff will be very happy to try and help you there. Just remains for me to wish you the very best of success in your own trading, ladies and gentlemen. Thank you for joining us, and I look forward to speaking to you soon. Trade well, everybody. Cheers.